Well, this is Hall Martin with Investor Connect. Today I'm here with Craig Vaughan of Vaughan Capital Advisors. Craig, thank you for joining us.
Hall, very good to be with you. Thank you for having me.
Well, great. Well, tell us more about Vaughan Capital Advisors, what you focus on, and how it works.
Absolutely. One of my favorite subjects, Hall. So, look, we started Vaughan Capital Advisors in 2012. I had experience at Goldman Sachs on the advisory side early on in my career. I then went in-house at Sony Pictures and 20th Century Fox to do consumer tech and entertainment deals. I then was at Creative Artist Agency for about 4 years, where I advised high-profile clients on mergers and acquisitions, did some sports M&A, and also launched a fund. And so in 2012, when I left Creative Artist Agency, I wanted to put together an advisory firm that's different from other, boutique M&A firms. We are solidly focused on media and consumer tech. Those are our sweet spots. We are very focused on the talent, coming from a talent agency background, meaning that we are looking at the management teams and seeing what's different about them, what's unique about their service model or product, and really positioning those founders and owner-operators to have great outcomes in M&A with much bigger, high-profile tech buyers and media buyers. Over the span of time from 2012 to today, we've advised major corporations like Google and Apple on acquisitions of companies that we were advising. We have taken founders from, 10 million in revenue when we met them to now doing 50 million in revenue through bringing growth private equity to them, and then ultimately having them exit to major corporations like WPP and IZEA, which is a publicly traded social media company. And so we really look to create personality-driven and human-driven transactions for our clients to get them the best outcomes from the companies that they've built.
Well, great. So I see you focus on capital raising. What is your focus there? What is your sweet spot as far as how much do you raise? What do you look for in the deals? That type of thing.
Yeah, sure. So look, when we help companies raise growth private equity, we're looking for companies that are post-revenue, meaningfully post-revenue, typically 15 million and up in top line. We do like to see EBITDA margins of between 15 and 25%. And we really want there to be a compelling reason for the growth capital. Typically, it's to expand geographically, to expand a service model, and it needs to be the on-ramp to considerable growth. And in that vein, we're able to attract private equity who see the opportunity, see the commitment of the management team. And we typically are bringing capital of somewhere between 10 and $15 million to these companies to help them accelerate their growth. And the private equity folks are looking for exits in 3 to 5 years. So pretty standard growth private equity stuff. But what I'd say is where we are different from other advisors in the market is that we really spend a lot of time with our clients at the beginning constructing the growth narrative and taking out some of the work that a typical private equity investor would need to do by having management prepared for the kind of structure that a private equity investor is looking for, the growth story, how to make the growth story actionable, and then making sure that the management team understands how a private equity deal works and the commitment they need to bring to the partnership. And so we've had some real success in doing that.
Well, great. So what are some of the trends in the media and the consumer tech world that you're seeing today? What's getting traction and activity?
Well, here's what I'd say. That we've had a period of, I'd say the last 10, maybe 15 years even, of massive amounts of capital going into the early stage market, early stage defined as venture, right? So seed, Series A, Series B. And as a result, there have been lots and lots of companies born. And I'd say at this point in the cycle, the market is determining whether or not it can absorb all of those startups. And what we're seeing is the market for M&A in particular and private equity is having a hard time absorbing all those companies. And so what we look for and what the trends tell us is if there is a company that has been able to show meaningful traction, as evidenced by 15, 20, $25 million in revenue, being able to show some path to profitability, if you will, a better mousetrap in terms of their technology or a better service model in terms of a service-oriented business. There is a market for those companies, both on the M&A side and the private equity side. I'd say what you're also seeing at the very top end of the market is massive consolidation. You're seeing it in broadcast, you're seeing it in print, you're seeing it in cable, across the board. And that's mainly because I think what we used to see as these massive bundle offerings to consumers are starting to be broken apart. So you see that in cable, you see that in subscription magazines, you see it in the record industry where you used to have to buy a CD that had 18 songs, only two of which you wanted. Now you can just buy a single or you can subscribe to a service. And so with that being said, I think a lot of advertising models are under pressure. Historical advertising models are under pressure. And so bigger businesses are looking for growth and they're looking for scale. And so if you're a good mid-sized business that again is showing meaningful 8-figure revenue levels and some decent profitability, there is a market for your company to be acquired.
So as the bundles go away and we move to streaming and subscription services, what are some good examples of companies actually achieving that, and what would be the success factor behind that, you think?
Well, I got to tell you, I'm glad you asked, and I don't have a great answer for you at the middle market and early market levels. So here's what I'll tell you is that if you think about OTT as an example, over the top, the most successful company in my view and over the top is Netflix, and they're gigantic. And that being said, they are still having to raise significant capital to keep their business model moving forward. You see where Disney has been very public about taking their content out of Netflix. And so Netflix is having to invest tons and loads of capital into creating original content. And I use Netflix as an example at the top end of the market to show how hard it can be for early stage companies to compete in that world. Now, there are lots and lots of OTT platforms that have been created, and some have been very successful in terms of exiting. So you see companies like Awesomeness TV exit to Verizon and Yahoo. You see Vice Media with a huge and lofty valuation. Those are examples that prove the rule of how hard it is for companies not named Awesomeness TV and Vice. And so right now, the market is supporting those OTT companies and early stage media companies through venture capital. The objective for those earlier stage companies is to create audience, and the audience ultimately will have value. So even if you can create audience at a loss, meaning without generating cash flow, the audience will have value to a much bigger player, big incumbent media player or technology player who can plug that audience into their platform. And so what we're seeing in the middle market to lower middle market are companies that are creating unique content, unique angles to attract attention, to create audience, frankly, with the plan being to get to a scale where a much bigger media company or technology company will find value in the platform and acquire it.
Are all audiences created equal, or is size and demographic impacting which is more valuable than the other?
Well, look, I think the first tripwire of value is really engagement. So that beyond all else, I think at the very beginning is the most important. So if you have an audience that's tuning in or logging in or engaging multiple times per day or as a daily routine, that's incredibly valuable. What I'd say secondarily is if you can go to a distributor or a content creator or an advertiser and say, to your point, I can deliver you this demographic, a particular demographic, that has tremendous value. Now, when you get into the demos, the hardest demo to reach anywhere, at least in the United States, is males 18 to 34. So that has a tremendous amount of value. That's part of the reason why live sports streaming rights are so valuable. NFL, NBA, to a lesser extent, MLB, MMA. Those are really valuable rights to have because they can deliver you the 18 to 34-year-old male audience. Then 18 to 34 or millennial females, obviously, high value. And then once you get beyond that demo, then you start breaking down into psychographic and cultural niches. And the analogy I always draw, and I think that we see patterns repeat every generation or two. If you look at the world of magazines right now, they are the way that they are for a very specific reason, is that back when all media companies had was print to reach audiences, they realized that not all audiences are created equal. So they created a young women's magazine, and then they created a middle-aged women's magazine, and then they created an older women's magazine. They created an all-male magazine, an all-sports magazine, and they started breaking up the audience into niches so they could sell those niches to advertisers. Well, if I fast forward that to today, that's the internet. But the internet is that times 1,000, right? Because it's all day, 24/7, interactive, very easy to switch. And so, again, if you're a startup or an early stage company and you can represent that you have a high engagement from a specific niche audience or a targeted demo, then there's a likelihood that your company will have tremendous value to advertisers and then by extension to acquirers.
Well, it seems like we're at the end of the bundled world, as you said. People are cutting the cable and they're moving to subscription services, and then even then they're only subscribing for a number of shows they want to see, and when that's up, they're gone. When Game of Thrones is finished, well, we cancel the
Mhm.
HBO subscription until next year when it comes back, and then they'll resubscribe for 6 weeks. So how does one make money in that kind of model there?
Yeah, I'll tell you, it's really hard, and I think that's what's driving the consolidation that I spoke about earlier at the very top end. So, as an example, you see Time Warner Cable and DirecTV and AT&T all coming together, right? That is about, or Time Warner, excuse me, not Time Warner Cable, but that is about, from a Time Warner perspective. That's about having HBO. From a DirecTV perspective, that's about being able to have reach and connectivity into the home. And then from an AT&T perspective, it's about both because they had their own television service and they also have wireless. And so now they're offering bigger bundles, right? So when all else fails, just do it bigger, right? So they're offering data, voice, video, and then in a world of net neutrality going away, they'll be able to advantage their content on their systems. So if they own HBO, they'll say, well, look, if you watch HBO, then we won't charge you data. But if you watch non-HBO video programming, i.e. Netflix, well, then you've got to, you're going to start bumping up against your data caps. And so the way you make money as a much bigger company is that you have to get into connectivity and bigger bundles. And you can do that if you're AT&T. If you're a much smaller company, you got to be in the hits business and you got to be in the differentiated services business, right? And so for Vice is a great example. A company's worth $4 billion. They have, really laser focused on a young, urban kind of citizen of the world demo that serves them very well. And they've then been able to leverage that brand and that model on multiple platforms, online, in print, which is where they started, and then in linear television through partnerships with companies like. So just to put a bow on it, you have to figure out what part of the ecosystem you're playing in. Obviously, not everybody's playing at the Time Warner, AT&T, DirecTV level, but if you're in the middle, you got to know you're in the middle. And if you're at the kind of middle market or lower middle market, then you have to have a strategy for that.
So where's the innovation going to come from? Is it going to come from the AT&Ts and the Verizons, or is it going to come from the Google, Amazon, Facebook crowd, or is it going to come from the traditional content providers, studios, and the artists and so forth? Where's the innovation going to come that really takes it to the next level? Because I kind of get a sense that technology is in a transition, but there's really not any content that's really driving it either. But so who's innovating, I guess, is the question.
Yeah, it's a great question, and I don't want to be cute about this, but I think what's happening is, and what ultimately will happen is the consumer is going to innovate. And not to go too broad on you here, but I've been sharing with folks for probably the last year and a half, to folks who will listen to me long enough, that I think that we exist right now in a broadcast television world. I mean, my generation for sure. And what I mean by that is, TV has been around at scale since the 60s, which is about 60 years ago. And it feels like a long time ago, but it's not that long of a time ago. So we grew up in a world where the television, it created norms through showing us kind of how to be through what we watch. And if you really dig down into it, ABC, NBC, CBS, which were the choices when I was growing up, they kind of had on the same news programming, pretty much the same sitcoms, pretty much the same hour-long crime dramas, with some slight variances, same variety television. And so we grew up in this world where everyone essentially had shared experiences. But before that, when the world was broken up to into cities and townships and that kind of thing, all those little cities and townships had their own unique experiences. They had their own church, their own grocery store, their own playhouse. And so I think we're going to get back to a place where content and experiences become highly individualized and somewhat more local, even if, and this is a hard one to wrap your head around, even if the locality is on a streaming service or on the internet. And what I mean by that is you're going to have folks start breaking off into their own little virtual cities and townships, and you're going to have these, small though aggregated groups that the innovation is around. Okay, we're all pretty much we all pretty much want to see the same things and have the same experiences. And we do that either where we can touch and feel each other through live experiences, which, by the way, live activation is becoming very important to advertisers, or we're doing it in smaller groups on the internet. So I think the innovation is actually going to come from how people want to experience things together versus it being a content innovation or something like that.
So the internet enables peer-to-peer interactions, and then you can reorder the peer-to-peer to be people of interest rather than people of locality. Instead of working with just people in my neighborhood, I can work with people who have the same interests I have in technology, books, or what have you. And so it just reorients it. And then what you're saying is you're going to create new worlds around those new interests as opposed to those old localities.
Yeah, and I do think it's a combination of both. I think there's a physicality to it. I do think people still want kind of in-person connectivity. I think that's why part of the reason why, as an example, in the music industry, festivals have become so important, and live experiences have become so important. You're starting to see, and we have an investment in a company that is essentially a pop-up festival company. They create highly targeted live events for niche audiences. So I think you're going to see a lot of that. And then to your point, which is what you were just describing, I think you will see more curated experiences for interest groups that are powered by the internet.
Wow. Well, cool. Well, in just a few minutes remaining, what else should we be talking about?
Well, look, I think that we're at a very interesting place in the world of media and consumer technology. I think we're also at a very interesting place in the world of financial markets. I think there's real stratification. And again, just to follow the same line of thinking the big are getting bigger, right? So the mega companies like Apple and Google and AT&T, they're getting bigger. And so the trickle-down effect of that consolidation is the middle gets bigger, and then there's the kind of the lower middle market. And that is where we focus. We focus on deals between, again, 15 million and 100 million in transaction value. And I think that for owner-operators and founders that are operating in that strata, there is a playbook to create value out of the business that you founded. It really kind of goes back to business fundamentals, which I love talking about with my clients. Figuring out what makes your company different and unique, figuring out how you deliver your service or a product that conveys value to the user, and then making sure you're thinking about your strategy to build enterprise value every day. As much as you're thinking about your to-do list, you should be thinking about your 2X list, which is how do I double my company in 18 to 24 months? We spend a lot of time with our clients on that. We are very transactional, but we're also very consultative at the beginning of our engagements because we want our clients and the companies we work with to understand that there is a pathway to creating value out of their business, but it needs to be very deliberate and very strategy driven. And once we can get that nailed with our clients, we feel very confident that we can bring growth capital or find the right acquirer for them to take their business to the next level.
Well, that's quite insightful, and I want to thank you for spending the time to share that with us today. For those who want to get in touch with you, what's the best way to do that?
Well, you can find us on the internet at www.vcapadvisors.com. We have a LinkedIn page. It's Vaughan Capital Advisors, and we're also on Facebook at Vaughan Capital Advisors. On our website, you can sign up for email list. We send out information regarding M&A in the middle market and trends in media and consumer technology. We would encourage everyone to sign up for that mailing list and get lots of great information about how to build their businesses.
Well, great. Well, appreciate your taking time and looking forward to seeing you back here soon.
Okay. Thank you, Hall. I really appreciate your time as well.